Former Bank of England Deputy Governor urges aggressive rate cut amidst U.S.-fueled economic uncertainty. The global economic landscape is teetering on the precipice of uncertainty, and a prominent voice from the Bank of England is sounding the alarm. Charlie Bean, a former deputy governor and chief economist of the Office for Budget Responsibility, OBR, has issued a stark warning, advocating for an immediate and substantial interest rate cut to mitigate the escalating economic fallout stemming from the volatile policies of the U.S. administration. Bean's call for a 0.5 percentage point reduction, bringing the rate down to 4%, underscores the gravity of the situation and the potential for widespread economic disruption. Bean's recommendation isn't born of knee-jerk reaction. It's rooted in a deep understanding of intricate economic mechanisms and the potential domino effect of the current instability. His long-held stance as an interest rate hawk, a testament to his conservative economic approach, adds significant weight to his urgent call for intervention. However, the unprecedented turmoil triggered by Donald Trump's trade tariffs has forced a recalibration of his perspective. He now believes the crazy situation unfolding in the U.S. demands decisive action from the Bank of England to safeguard the U.K. economy. The core of Bean's argument rests on the crippling uncertainty that pervades the business landscape. The looming threat of further tariff hikes and the unpredictable nature of U.S. trade policy are creating a climate of apprehension that stifles investment and dampens consumer spending. Businesses, understandably hesitant to commit capital in such an unstable environment, are delaying crucial investments, a trend that will inevitably lead to slower economic growth and potentially a recession. Bean's analysis isn't an isolated viewpoint. It echoes the concerns of other respected economic figures, further highlighting the seriousness of the impending economic storm. David Blanchflower, another former bank rate setter, supports Bean's assessment, emphasizing the magnitude of the economic shock and urging the Bank of England to take swift action. Blanchflower goes even further, suggesting that an emergency meeting be convened before the scheduled May 8th meeting to address the situation with the necessary urgency. He argues that a deep reduction in borrowing costs is essential to prevent a potential crisis. The potential consequences of inaction are far-reaching and deeply concerning. The collapse of even a single major financial institution or hedge fund in the U.S. could trigger a cascade of panic, leading to a broader financial crisis mirroring the recent turmoil surrounding the LDI pension scheme. That crisis, precipitated by the instability following Liz Truss's mini-budget, served as a stark reminder of the systemic risks inherent in volatile economic conditions. The Bank of England's dramatic intervention with a 1.5 percentage point cut then showcased the scale of intervention sometimes required to stabilize markets. Bean's recommendation underscores a critical juncture. It's not just about mitigating the immediate impact of U.S. trade policies. It's about preventing a chain reaction that could plunge the UK economy into a prolonged period of stagnation. The Bank of England faces a crucial decision: to act decisively and preemptively, or to risk a potentially catastrophic economic downturn. The need for a proactive approach is undeniable, and the urgency of Bean's call cannot be overstated. The coming weeks will be pivotal in determining whether the Bank of England heeds this warning and takes the necessary steps to safeguard the UK's economic future. The stakes are high, and the time for decisive action is now. The world watches with bated breath.